Good morning and good afternoon to everyone who has joined us this financial year 2020 results call of the JSE. I am Leila Fourie, the CEO of the JSE, and I wanted to start by sharing my thoughts on 2020, which has from all angles been an incredibly challenging and important year for the company, for its stakeholders and for our country. We started the year faced with a deteriorating operating environment, but hopeful about our projects and the government's plans to foster a cohesive society and a stronger economy. The pandemic then started occupying headlines a year ago. We're all aware about the political and economic repercussions of this crisis, in South Africa particularly. The pandemic destabilized economies and societies. The turbulence was exacerbated by low growth, high unemployment, and SA's fiscal debt burden. Our local markets took their cue from the pandemic-fueled uncertainty and a historic crash in oil prices. Local market volatility was amplified by the sovereign credit rating downgrade and the ejection from the World Government Bond Index, culminating in record volatility on our exchange. I hope and I'm confident that the worst is now behind us and that the only way forward is up for South Africa's economy. The global political and macroeconomic environment remains complex and volatile, and we do have a number of key assets in this country that should help us to recover from this difficult situation. And as I said in the past, a stronger governance and regulatory framework is critical for South Africa to recover, inspire trust and foster economic growth, and to ensure the political and social stability in our country. As far as the JSE is concerned, I'm proud of how the company, employees and management have responded in unison to the challenges posed by the pandemic, and I would like to extend my most sincere appreciation to all of those who have contributed to the achievements of this year. As the CEO of the Stock Exchange, I'd like to genuinely stop to thank my colleagues, the board and the market participants at the JSE for their energy, their dedication, but I'd also like to reiterate that we're looking forward to contributing further to the national agenda in 2021. As we move to slide 2, I'm going to just cover off the agenda, and it's really my pleasure to join this earnings call. And our agenda for today is as follows. I'll start with key highlights for the year before my colleague and CFO Artie Takurdin will delve into the numbers with the usual financial review. I'll then come back to wrap up the presentation and to provide some outlook. As we move to slide 4 and look at 2020 at a glance, we are really pleased to share a strong set of financial results for 2020. In the context of a challenging year, the JSE delivered strong financial performance and business resilience. Our operations held up against record-breaking volatility under unprecedented circumstances. This means that clients were able to trade, clear and settle across all asset classes throughout the crisis. During times of great volatility, uninterrupted operations are crucial for our clients. We achieve this through consistent targeted investment into our systems and infrastructure over a number of years. In addition, the business proved once again that it is anti-fragile, creating real value for shareholders despite the challenges in the real economy. We achieve this through consistent cash generation, attractive dividends, and continued reinvestment into the growth of the business. With regards to growth and looking at our inorganic growth strategy, we are doing exactly as we promised. We recently announced the successful completion of the Link South Africa Market Services acquisition, and we also are very pleased that we were able to announce our collaboration with and an equity stake with Globacap. And I'm pleased to share that we've completed the deal in January of 2021. With regards finances, our financial position is strong. We generated 14% more cash from operations. We invested in growth initiatives, and we rewarded our shareholders with a 5% increase in dividends. Revenue growth was largely driven by heightened market volatility and trading activity, primarily in the first half of the year. This was positive for group margins, ending the year with positive operating leverage. The group's balance sheet is healthy, giving us room to explore targeted growth opportunities, and Artie will provide more details on our financial performance later. So in conclusion, what this means is that the JSE has delivered real value to its stakeholders. The importance of a stable and robust market cannot be stressed enough. The economy needs a stable market infrastructure to attract investment and to support financial innovation. Our business model allows us to do just that. High quality of earnings with a strong core business model means that we can support our growth objectives. Our balance sheet remains strong, and we will continue to deliver on our inorganic growth strategy. Shifting to slide 5, this is how it all translated into numbers. Revenue was up 13% year on year. Operating expenditure increased at a slower pace than revenue at 11% year on year. And that led to some margin accretion, with EBIT margin reaching 32%, up 1 percentage point year on year. Moving down our income statement, earnings per share and headline earnings per share both increased 15% in line with revenue growth to 936.7 cents. On that basis, an ordinary dividend of 725 cents per share was declared, representing an 83% payout ratio. Our ordinary dividend was also up 5% year on year, such growth being allowed by continued strong cash generation, itself 13% higher year on year. And there's a CAPEX amount of 89 million, which Artie will comment on. Shifting to slide 6 and switching quickly to an important chart which shows how cash generative the JSE continues to be. Cash generated from operations was up slightly higher than the adjusted earnings for the second year in a row, whilst cash conversion of adjusted earnings has remained consistently high since 2016. As you can see, this is a testament to the JSE's earnings quality, something that we are committed to sustain in the future. Moving to slide 7 and a quick look now at volatility and trading activity on the equity market in 2020. This shows quite how unique this year was. Market activity was stronger in half year 1 than in half year 2, with the highest volumes traded in March and April, before slowing down during the mid-year and a decline in volumes in quarter 3 and October, before market activity went back up again in November and December. And in terms of price volatility now, our all-share index, or ALSI, has now had quite a bumpy year, as we know, with great volatility, particularly in March, April, and then June and November. Now, this explains, of course, a large part of our revenue growth and margin accretion in 2020. Equally, this confirms how challenging the market environment was in 2020. In the face of this challenging operating environment, the JSE showed exceptional business continuity and operational resilience in 2020. Importantly, the JSE managed to emerge from the crisis as a trusted marketplace, underpinned by strong business resilience and continuity, which is the key pillar of our strategy. Our approach was centered around three key priorities. Starting with our social focus, we collaborated with the BLSA on outreach initiatives and launched our #Trade for Solidarity campaign, which saw an enormous unified effort from the JSE and market participants to contribute towards the fight against COVID-19. On business resilience, I am incredibly proud that we were able to improve market availability to 99.95%. This is well above our 99.7 targeted SLA, and it's up from last year. We also had zero equity market system downtime, which is genuinely exceptional given that the staff were operating remotely for the first time in the JSE's history. This brings me to our third priority of client centricity. It's crucial for the exchange to be alive and responsive to the challenges facing our clients. During 2020, we provided relief to distressed clients, and we provided regulatory support to our issuers. We also provided comprehensive support to our employees, culminating in record high staff engagement results. And we're incredibly proud that we were able to improve our BEE rating from level 3 to level 2. On slide 9, we can see that 2020 was a busy year for us, with multiple projects across various segments. In the regulatory space, we introduced standard listings, which ensure that we can attract a broader range of issuers for our investors. We also introduced our revised debt listings requirements, approved by the FMA after extensive market consultation. I'm also very pleased that we were able to introduce the sustainability segment, which has attracted significant interest, with positive indications of a listings pipeline. Demand for sustainability-focused products is growing globally, and the JSE remains committed to providing the market with the tools that are needed to direct investment towards sustainability. In the data space, we migrated our cash bonds data to a new platform and signed an agreement with CIIS in China for the distribution of select JSE market data in mainland China, opening up a new and significant market for us. Our core trading engine was upgraded in August, supporting our ongoing tech resilience. Meanwhile, in post-trade services, the BDA platform was upgraded, whilst JSE Clear is now poised to submit the final license application to become an independent clearinghouse. Our inorganic strategy is well underway, with 2 inorganic highlights which we're very pleased to present. First, the completion of Link, now JSE Investor Services, in November 2020, and now our transaction with Globacap, which will support our work towards a digital private placement platform and registry services. I'm now going to shift to our business review, and on slide 11, we're going to delve into our business performance per segment. To start with, revenue for our core capital markets business is up 7%. This was driven by higher trading activity on the equity market and more central order book activity. Meanwhile, we achieved double-digit growth in both post-trade services and information services. Post-trade services benefited from greater trading activity on our markets and was up 14%. Whilst information services growth was largely driven by new business, positive pricing and FX. Shifting Shifting to slide 12, our revenue was driven largely by greater market activity. And as I said, so let's look at the market drivers in a bit more detail. Fewer IPOs in 2020 owing to uncertain market conditions. There was new equity capital raised in the secondary market of 67 billion, more than 80% up on last year. The number of cash equity transactions was up 21% year on year in a highly volatile market, which resulted in a 7% growth in billable equity value traded. And there was a number of derivative contracts traded on the equity and currency derivative markets, whilst interest rate derivatives saw double-digit growth. In the equity derivatives market, we saw an increase in index futures transactions, international derivatives, and can-do options, which are exotics. In our currency derivative market, during the height of the market crisis in March, bid-offer spreads in the currency market were 40 to 50% higher than their pre-COVID-19 levels. And this has started to normalize, but volatility in the rand has contributed to erratic trading activity in this space, where a large portion of the trade is linked to hedging activity in the equity market. Finally, on the bond market, the nominal value of bonds traded declined 7%, pretty much as SA exited the World Government Bond Index, resulting in enormous foreign capital outflows. Moving to slide 13, we see a close-up on our primary markets. The revenue of 3% was increased on, the increase in revenue was 3% on last year. We had 4 new IPOs in 2020 and 20 delistings, which resulted from corporate actions and schemes of arrangement, mostly in small to mid-sized illiquid counters. Bond listings were also under pressure owing to market uncertainty against a high financial year 19 base, but in line with previous years. Now, despite a decline in the number of listed entities, the aggregate market cap of all equity listed entities on the JSE has increased by 2% in the year. In addition, we saw an increase in listing of exchange-traded notes, which grew 8-fold versus 2019. Finally, we note a growing demand for green bonds in emerging markets, and we're hopeful that this trend will persist in the future. Shifting to slide 14, the main driver of our revenue performance in 2020 was the equity market, accounting for 22% of total revenue and growing 14% year on year. That included a strong first half driven by COVID-related volatility, whilst the second half as we've seen earlier, was more erratic with volume swings that were less noticeable and reduced price volatility. In effect, the revenue grew on the back of increased billable value traded and more central order book activity, resulting in higher effective pricing. Lastly, during a busy year, we brought major upgrades to our core trading engine as planned, and we're very grateful to market participants for their support in this regard. Shifting to slide 15, overall our performance was broadly stable with revenue up 1%. Starting with equity derivatives, revenue growth was owing to higher transactions in the index futures, growth in international derivatives and exotic products, and revenue from the interest rate market was up 4% due to market volatility, which drove the number of standard trades higher and a positive mix impact. This was achieved against an incredibly challenging market backdrop, large foreign capital outflows, and a 7% reduction in value traded overall. With regards to the interest rate derivatives market, the increased volatility and trade activity has resulted in increased hedging activity in the bond futures market, and as a result, we've seen an increase in revenue year on year. Currency derivative revenue was down 3% owing to a decline in contracts traded. And as a reminder, in March, bid-offer spreads between the currency market were 40 to 50% higher than their pre-COVID levels. This has started to normalize since then, but volatility in the rand contributed to erratic trading, which for a large part is linked to hedging activity in the equity market. Shifting to slide 16, revenue on the commodity derivatives market was up 7% year on year. And as a reminder, this market relies essentially on agricultural product futures. Revenue growth was underpinned by better pricing and a more favourable mix of traded products, whilst volumes were broadly flat as the overall market has seen little disruption from the pandemic given its export-oriented nature. Finally, we're still on track for the launch of a new class of derivative products, the deliverable diesel contracts, with an expectation to go live in 2021. On slide 17, we can see that the post-trade services revenue is up 14% overall. And as a reminder, the revenue in the post-trade services environment is by nature intrinsically linked to trading activity on our markets, which explains the double-digit growth in year on year. BDA and clearing and settlement businesses grew both double digits. Clearing and settlement only relates to the equity market and was therefore driven by higher billable value traded and central order book activity on this segment. Now, BDA posted a 13% revenue increase despite pricing pressures and as a result of 21% increase in the number of transactions, although smaller ones. Funds under management were up 9%, driven by JSE trustees' higher cash balances. Moving on to slide 18, last but most definitely not least on business performance is our information services business line. The segment's revenue, which is annuity driven, increased by an impressive 15%. We signed up 24 new clients for market data products, whilst we managed to increase prices and benefited from a positive FX gain from US dollar denominated revenue, an excellent hedge in that business line. And in terms of business update, we note that we launched the FTSE Russell fixed income indices. Most importantly, we entered into an agreement for the distribution of our market data in mainland China, with more updates to come on this in 2021. That was all for our business review. I thank you for listening, and I'll leave the floor now to our CFO, Artie Takurdian, who is our CFO, and she'll talk to us about the financial review. Artie, over to you.
Thanks very much, Leila. Indeed, it is such a pleasure and a privilege, in fact, to be able to report such strong financials in what is a very difficult operating environment, as Leila has set out. So in financial terms, the total revenue growth of 13% resulted in positive operating leverage, which is very important for us, and some margin accretion. Particularly pleasing is that in absolute terms, revenue is at a record high for the group. Operating expenditure growth was 11% and EBIT margin climbed 100 basis points to 32%. Now, excluding depreciation and amortization charges, which in of itself grew 22% year on year, EBITDA was up 19% year on year, delivering even greater margin accretion. in recognition of the high non-cash component of costs within this cost base, you can expect us to emphasize the EBITDA metric as a key financial metric going forward. Our effective tax rate continues to be well managed, and earnings per share grew higher than revenue growth at 15%. Now, as is consistent with prior years and a strong feature of the JSE business model, as Leila pointed out, these earnings have converted into strong cash generation, which reached another record high for the group in 2020 at over 104% of earnings. The CAPEX spend ended at 89 million, which is slightly off our guidance of 140 million, and I'll emphasize that further as we go. We exit the year almost flat on cash balances, which remain strong even after accounting for the payment of the purchase price for the now called JSE Investor Services, or JIS business. This represented nearly 10% of that cash balance. On the back of this strong performance, we declared a 5% ordinary dividend growth to 725 cents per share. That is an 83% payout based on distributable net income. You will read in our detailed financial documents that the board approved to make a change on the dividend policy. Where the old policy cited a 40 to 67% payout ratio or 1.5 to 2.5 times cover, we have now improved and narrowed the band to 67 to 100% payout ratio or 1 to 1.5 times cover, which again is in recognition of the cash generation exceeding earnings on the back of the high non-cash component of costs. The new dividend payout band addresses this, enabling the declaration of the ordinary dividend. On a deep dive basis, in terms of the financial statements, a few call-outs on the income statement. Other income includes forex gains realized in the year, as well as regulatory fines that does not form part of that distributable net income. We flagged that we would also see lower net finance income owing to the lower yields on the cash balances. So indeed, net finance income contraction is the main reason for the delta between the earnings before and after tax, and this was as anticipated. The first-time consolidation of the JIS business, note, for only 2 months, means that a non-controlling interest carve-out for minority shareholders is now evident on the face of the income statement. If we reflect on revenue a bit further, we are particularly proud of the quality of the growth in the operating revenue of 12%, because it's reflective of the growth in activity drivers as opposed to being exclusively derived from price increases. We thought we'd share effective price points for the overall cash equity market. As you can see, our pricing trend over the years demonstrates our commitment to remaining competitive in this space. And if you draw a trend line, it is trending down aligned to global exchange trends. 2020 effective prices are reflective of the distinctly different trading patterns, as Leila mentioned, in terms of the mix between off-order book and on-order book trades, which are priced very differently. Now, our billing models are diverse, whether the fee line is based on volume or value traded, or differing BIPs and caps. So too is the rest of the revenue stack in the group. The business offers diversification of products and service offerings, pricing models, as well as FX or currency. Our inorganic efforts, as we've guided before, looks to strengthen this diversification. Now, if we move on to costs, cost management remains a critical focus for the management team. I want to pause here on the costs growth of 11%, dear analysts, and share with you that we worked incredibly hard to maintain the fixed cost base to 8% growth, and we strip out all the new costs and non-recurring costs in specific to transaction costs for the year on the right-hand side of this graph. And that 11% cost growth is something we're perfectly calm about as management. So as you can see, the remainder on the right-hand side towers that map out the JIS business costs, the Jeff Trust consolidation costs, or rather costs on consolidation, as well as the transaction costs, which are mostly related to Globacap and the JSE deals, are stripped out. The non-recurring costs, they're very immaterial, but were material at H1 last year. So we've included them for completeness in this view, so that it's mostly to demonstrate the flattening out for the annualized effect. Now, we've previously guided on the base effect, which is offset somehow, and this is how you saw that it became immaterial in H2, because it was offset by savings that offset those one-off COVID-related and base effect costs. In terms of the costs by category, we present greater detail on year-on-year growth by category. Now, just to highlight the personnel expenses, which is a factor of headcount and annual increases, we ended the year on a headcount of 402, which is higher than the prior 3 years because of our vacancy factor, tracking a very different trend due to what we believe due to the pandemic, where, like most organizations, attrition rates have slowed down. And the other factor to the personnel expense increase is gross remuneration being up 4%. But these numbers are inclusive of a 1% growth related to the JIS personnel costs. As I mentioned, Jeff Trust and JIS, so the new businesses, entered the scope of consolidation for the first time, and we set out those costs herein. As usual, a reminder of our future depreciation profile over 2021 and 2022. This is updated with our latest CAPEX plan. We are expecting to reach a peak in our depreciation expense in 2021 at 259 million rand this year, a 5% increase on last year's 2020. A large part of this, as we've guided, relates to ITAC. Meanwhile, IFRS 16 depreciation charges will broadly remain stable. In CAPEX terms, CAPEX amounted to 89 million in 2020 and was mostly driven by the upgrade of our core trading engine and to a lesser extent to our new master reference data system. The 89 million CAPEX final envelope for 2020 was lower than expected, than we guided, and the difference is mostly explained as follows. So we had costs related to the OTC clearing project, which is still in design phase. Those were expensed rather than capitalized. The same applies to the IT mainframe migration plan, which is being currently expensed in the 2021 year. And we achieved savings on the trading engine upgrade and building costs compared to original plan. Looking ahead, 2021 will see a greater CAPEX allocation, estimated at 145 million, where we have given an indication of the book of work on this slide. Notwithstanding our investing activities, including the purchase price of JIS business of just over 225 million, we land on nearly flat cash balance from last year. The cash is fully supportive of our regulatory capital requirements, our planned CAPEX 145 million for 2021, and some cash set aside for inorganic activity, and the surplus, as usual, has been distributed in the ordinary dividend of 725 cents per share, which delivers, as promised, a progressive ordinary dividend over last year after accounting for our cash requirements. As I mentioned earlier, the new dividend policy lifted and narrowed to the new payout ratio, which allows for the declaration, and we are delighted to be able to deliver incremental value to our shareholders in such times. We have a strong divvy track record, and as we allocate capital towards inorganic efforts, it's important that you take comfort that any inorganic growth acquisitions have risk-adjusted hurdle rates against which we evaluate the deal and track post the transaction in terms of actual performance. We're also at this time not considering any mega deals, which enables that dual strategy of growing the business over time through inorganic activity and at the same time delivering value to shareholders in the way of a progressive ordinary dividend. That brings the financial review to a close. I'm happy to take questions later on, but for now I shall hand back to Leila for looking ahead.
Thanks, Artie. Let's move on to the outlook section of this presentation before we conclude. It's now been more than 18 months that I've been in my role as the CEO of the JSE, and I see tremendous potential and great energy within the organization, combined with a number of market opportunities that we can leverage to grow. Our key strategic priorities are clear. We have a high dependency on equity market revenues. We want to diversify away from this by growing different revenue streams that are more annuity driven. Secondly, investing in robust IT infrastructure is absolutely critical to maintaining strong resilience against a number of threats, including cyber threats. We're also focused on the national agenda and on how we can contribute to making South Africa an attractive investment destination, whilst further embedding sustainability within our business. And importantly, these strategic objectives will be supported by a strong corporate culture and world-class customer experience, creating enduring stakeholder value. If we shift now to slide 32, the capital allocation on this slide is a reflection of this strategic framework. Before any other consideration, as a priority, we will ensure that the level of regulatory capital is maintained. Beyond this, we prioritize organic investments, essentially focusing on robust systems and revenue generation from new products and services. Inorganic investments in order to diversify our revenue with a focus on annuity income in the issuer services and data space. I'll expand on that shortly. And as you know, we have maintained a healthy balance sheet with no debt, providing us with good optionality in terms of how we want to grow and with which financing options. Lastly, our growth focus. We are committed to distributing sustainable ordinary dividends. We've distributed dividends in excess of our payout policy in the last few years. As Artie just mentioned, the board decided to broaden the ordinary dividend payout ratio to between 67% and 100%, remembering that previously it was 40% to 67%. Moving on to slide 33, first, and the acquisition of our JSE Investor Services, which was previously Link South Africa. The business is involved in the transfer of secretarial and registry services, and Link is the second largest share registry in South Africa, with a client base of over 90 issuers, including 6 of the top 40 issuers listed on the JSE. After final completion of the deal in November and the payment of 225 million rand in Q4, we are currently in the process of onboarding and integrating the business, all going well and in line with plan. Moving forward, we will introduce products such as ShareHub and our virtual AGMs to corporates in South Africa to complement the shareholder communication and engagement. With regard to new opportunities for JSE Investor Services, these include things like asset reunification, share register cleanups, share register analytics, and call center training, and executive share schemes. Moving on to slide 34, we announced a commercial arrangement with Globacap in November, including the acquisition of a £4 million minority equity stake in the company, which was paid in January of this year. Now, what is Globacap and why does this transaction make sense? In a UK-based market leader, it's a private equity capital markets environment, and they provide an essential financial ecosystem for private companies through issuance, liquidity, and registrar services, with technology and distributed ledger technology at the heart of their business. The plan is to collaborate and establish a private placements platform in South Africa and potentially other African countries in order to advance and digitize capital raising for infrastructure finance and SMEs into the continent. This is a very promising business opportunity that we've invested in, with interesting growth potential for a business that is, from many angles, a pioneer in private capital markets. Importantly, similar to the acquisition of Link, those transactions are fully in line with the strategic acquisition criteria that I've just disclosed in the previous slide. And I'm hopeful that we'll have more news to share with you in the next few months in terms of inorganic growth and business opportunities. Moving on to slide 35, finally, as we reflect on the year, I want to wrap up with key takeaways of this presentation. In summary, the JSE has delivered value at a time of great uncertainty and economic pressure. We demonstrated that the JSE is resilient, flexible, and responsive, and a business that can absorb significant market swings and deal with unprecedented operational challenges. At the same time, we remained committed to supporting our clients, our staff, and communities during these extremely challenging months. Financially and operationally, we are well positioned to carry out our strategy. We will continue to invest in core business resilience while delivering on growth initiatives, both organic and inorganic. And we delivered consistently high earnings, high quality of earnings in the core business. And importantly, our healthy balance sheet allows us to explore sustainable growth opportunities. We are well capitalized with robust liquidity, and we increased the ordinary dividend by 5% and maintained a sustainable payout. The years ahead require steady, disciplined work. We will execute our strategy with speed and discipline and continue to rapidly improve our service offerings and technology to service our clients with consistent excellence. This brings us to the end of our presentation. We are very happy to now open for questions.
No questions at this time?
No questions at this time. We'll give it a few moments.
We woke up one morning and the world had changed. In an instant, our lives were filled with new words, new images, and new things to fear. But the best parts of us remain. What makes us human will endure. We solve problems. We learn. We innovate. We cooperate. We have compassion and we have patience. We make each other brave. Now is the time to be brave together, to reach out and do what we can for those who need it most. The JSE is proud to announce the Solidarity Trading Days.
Hi, Leila and Arti. We've got one question that's come through. Someone asked, there was some publicity yesterday talking about that the JSE would be looking at transition bonds. Please, would you let us know what the progress is on that?
Sure. Thank you for that question. We discussed yesterday in the media the concept of transition bonds. Let me start at the outset to say that we are seeing a material pickup in the sustainable finance flows globally, and we expect that to translate into the South African flows. South Africa typically tends to lag international markets slightly. We are investigating and contemplating listing or opening a listings environment for a transition bond. Transition bonds will be built upon our already well-established stack of sustainable bonds. We have 11 green bonds, which are 3 to 4 times oversubscribed, and we've recently introduced sustainable and social bonds. The transition bonds would really allow those companies that are typically fossil fuel driven in their business activities, to use debt funding in the transition bond to transition them away from fossil fuel environments into a more green environment. Of course, this is an important element and an important enabler to allow the JSE to enable smooth transitioning. We don't want to see dislocation through stranded assets where fossil fuel companies are not able to access financing. And so we believe the transition bond is an important transition mechanism, as its name suggests, and we're very excited about it. It will take at least 6 months for us to get through the regulatory process, and we look forward to potentially launching this. Are there any more questions, Pelly?
No, there aren't any more questions.
Great. With that, we will wrap up, and I would like to, on behalf of our board and the organization, thank you for listening. We've had a tremendously positive year. We owe a depth of gratitude to our market participants. I owe a depth of gratitude to my chairman, our board, to particularly my executive, and to all of the staff that made these sterling results possible. We look forward to engaging with you in our one-on-ones and in the year ahead. Thank you for listening.
We woke up one morning and the world had changed. In an instant, our lives were filled with new words, new images, and new things to fear. But the best parts of us remain. What makes us human will endure. We solve problems. We learn. We innovate. We cooperate. We have compassion and we have patience. We make each other brave. Now is the time to be brave together, to reach out and do what we can for those who need it most. The JSE is proud to announce the Solidarity Trading Days.